Being prepared for a mortgage application as a first-time buyer is the deciding factor whether you're going to get your offer accepted on a house or not. In this video, we're going to break down the 5 biggest tips for a first-time buyer going through the mortgage application process. So when you're applying for a mortgage, there's 3 main factors that you need to be able to get yourself approved for the mortgage application. The first one is credit. So the first tip we're going to go through for the mortgage application process is in regards to credit score. So credit score in its own isn't all that it's cracked up to be. So for example, you can look at 5 different credit reporting systems and every single one of them will give you a different number. So this number gives you a rough indication as to what your credit score is like, but also when you submit your application to your lender, they've also got their own internal scoring system, which will also be dramatically different to the numbers that are on your credit score. So the main thing that you need to look at on your credit report when you're applying for a mortgage, the first one to give you a massive credit score increase is making sure that you're registered on the electoral roll. Doing this will make it easier for the lender to find you at your address, and because of this, it can give you a quick boost in your credit score for the application. But the main thing lenders look for is missed payments. So all a credit score and credit report is just a scorecard to show how good you've been in the past of being actually able to pay your payments on money that you've borrowed. So the main thing lenders look at are these missed payments. So if you've got anything set up for a direct debit, you need to make sure you've got the funds in the account to cover any payments. Most importantly of all, you need to make sure that if you've got a credit card, a loan, a car hire, that everything is set up to come out automatically from direct debit, because if you do miss these particular payments, it can put you in a position that as you're going through the mortgage application process, especially if the missed payments are within the last 12 months, it may kick back a lot of high street lenders and force you to go into a lender that you may have to go to that specialises in people with missed payments, and because of that they do charge you a higher interest. Another thing to check on your credit score, and this is why it's so important to check way in advance of applying for your mortgage, is making sure the information they've got on you is correct. The main reason being is we've seen it time and time again where people have had missed payments, CCJs, even defaults registered in their name that aren't actually correct. And once they've disputed these with the lender, they've been able to get these removed from the credit score, meaning that they will be able to get a cheaper interest rate and give them a higher chance of their mortgage application going through. And just because you've got bad credit or have missed payments, it also doesn't mean that the chances of you getting a mortgage are completely evaporated. It does potentially reduce the amount of lenders you've got, but as long as you've got a big enough deposit, there are lenders out there that will be happy to lend to you even if you've missed payments. But when I say a bigger deposit, most lenders, if you've got a 15% deposit, some of the specialty lenders then open up their books to people that have missed payments in the past. So whereabouts can you check your credit score? So we use a system called Check My File. The reason we use Check My File, it gives us more information than just going directly to Experian or Equifax on its own. It actually brings up credit reports from 3 different systems in one go, and a nice, easy to read report. And it's free for the first 30 days. You can cancel at any time, and therefore after it's $14.99 a month. We have got a link in the bio. If you want to click that and download it, you can have a look at your credit report and kind of see if there's any issues and what needs to be amended. The second pillar of getting yourself agreed for your mortgage is in regards to income. So depending on which lender you look at, every lender assesses your income completely different. And this is why it's so important to speak to a mortgage advisor up front, so they can have a look at your income. Because for example, if you are self-employed with 1 year's accounts, or a self-employed limited company director, or if you are a job which pays you mainly in commission and overtime, each 3 of those factors, there will be different lenders that can lend you more money than another lender. If you're employed, they'll take 100% of your basic salary, and they will usually give you an income multiple between 4.5 to 5.5 times your income as a first-time buyer, as long as you qualify with the correct lenders. You've then got lenders that look at bonuses, overtime and commission. And what they'll look at is the average of your last 3 months. So when you look at the average of your last 3 months, they'll divide that by 3, times that by 12, and then they'll times that by the 4.5 to 5.5 to figure out how much it is you can borrow. If you're self-employed, again, lenders look at this in so many different ways. So for example, there are lenders out there that will just take your most recent year's accounts. There's also lenders out there that want to make sure you've got 2 years accounts before they can go through the mortgage application process. As a general rule of thumb, if you're a sole trader, they'll look at the average of your last 2 years worth of accounts and times that by 4.5. If you're looking at being a limited company director, they'll look at your net profits that the business has earned and the director's salary you've paid yourself, and then they times that by 4.5 as well. This is the maximum cap, the 4.5 to 5.5. However, if you've got children, debts, other financial commitments, it might slightly reduce the amount you can borrow as you go through the application process. So what documents do you need when you're proving your income? Again, if you receive bonus and it's an annual bonus, you need to see the last 2 years worth of bonus pay slips. If it's received monthly, you need to see the last 3 months. And if you're self-employed, they want to see your limited company accounts for the last 2 years if you have them. And then you want to see your last 2 years, tax year overviews and tax calculations. And again, there are lenders that will take 1 year, but as a general rule of thumb, having the 2 years opens the doorways up to other lenders. The third thing that you need to have in place to be able to get yourself agreed for your mortgage. So you've got your income in place, you've got your credit report all good to go. The most important thing next is your deposit. So as we are speaking today, there are 100% mortgages out there, but the majority of lenders will need you to put down a deposit for the property. The bigger the deposit, the cheaper the interest rates. So for example, if you put down a 5% deposit, because you're seen as high risk to the lenders, it puts you in a position where, because of the high risk they're taking on yourself, if they have to repossess the property and the property market dips, they may lose money. So because of this, they do charge you a slightly higher rate. Every extra 5% of a deposit that you put down, the interest rates get cheaper. So for example, when you get to 10%, the rates will drop, 15% the rates will drop again, but if you put down 14.99% deposit, you still qualify for 10% deposit products rather than the 15% ones. So where can your deposit come from? This can come from numerous sources, but there needs to be a paper trail as to wherever it's coming from. You can't just use cash that's under your mattress. So for example, your deposit can come from savings, it can come from a gift, and if it's a gift from a family member, they need to write a letter saying it's a gift, it doesn't need to be repaid, and on top of that, it needs to make sure it says that they do not own any interest in that particular property. Because if they're putting it down it's a loan and you're paying them back at £300 a month, the lender can use this as an outgoing, which may reduce the amount that you can borrow. Tip number 4 is stay away from high risk factors that may get your mortgage declined. So there are 2 major high risk factors that will be an automatic decline in a lot of lenders' books. And the first one is payday loans. So from a lender's perspective, they do not feel comfortable giving people money that have had to take a payday loan out at a ridiculous interest rate because they're struggling to pay their bills at the time. So that is an instant red flag when you're going through the mortgage application. So if that is the case, some lenders want to make sure that you've not taken these out within the last 2 years. Some will say if you've taken it in the last 12 months, they'll completely decline yourself. So if this is the case, be very transparent with your mortgage advisor up front. Because if they go through the process and it gets unearthed that you have had these in the past, there's a high possibility that the lenders will completely decline the application for you. The next red flag is gambling. Having the odd flutter here and there on the football accumulator on the weekend or the Grand National is not so much of an issue. However, if we can see consistent transactions coming out of your account for any betting accounts, for example, seeing multiple transactions for £300–400 a month, there can potentially be an issue with the lender, depending on your income and how much you're spending on gambling, that the lender will completely decline the application because they see it as high risk. And if they believe you've got a gambling habit, it puts them at risk of having to repossess the house if you're not keeping up with your payments. And like I said, having your flutter here and there is not so bad, but in the run up to going for the mortgage application, just make sure you knock all the gambling on the head just to prevent any heartaches down the line when you do find that perfect property you want to move into. And tip number 5 is speaking to a mortgage advisor way in advance of you actually looking at a property. One of the reasons we say this is if you're looking at going through the mortgage application process, there are so many hurdles for you to jump through and nobody ever teaches you how to buy a property when you're at school. You kind of get thrown in the deep end and you've got to figure it out on your own. The reason it's so important to speak to somebody up front is they can talk to you about how much you can borrow, how much deposit you need, they can assess your credit report to see if there's anything that can be changed and tweaked. So when you are ready to buy a house in the next 6 months, everything's all lined up and the process is a lot more seamless later on down the line. We have got a link in the bio, and if you want to find out more details and speak to somebody and have a more personalised conversation about your mortgage application process, reach out, we can have a conversation with one of the friendly team and we can find out how much you can borrow, the deposit you need and what are the next steps to be able to get yourself on the property ladder.